Yesterday we saw a lot of red across the market, in particular for those companies in the software company. If we take a look at Salesforce, they were down around 20% after reporting their earnings, as well as UiPath down 34%. This also had a knock-on effect on other companies in the similar industry of software, and as we can see, Snowflake itself was down nearly 5%, and right now they are trading right there at their 52-week low. We also see a buy rating from Wall Street, and in today's episode, we are going to take a look at whether now is a great opportunity to buy this undervalued, very strong growth company for massive future gains. As always, we are going to take a look at some of their underlying metrics, the growth that they have seen on a free cash flow, sales growth, the ROICs. But as well as that, we do want to take a look at insider movement. We do note some insider selling as well as insider buying. We also want to take a look at institutional movement, whether they've been buying or selling in the more recent quarters. We'll also take a look at their latest investor presentation just from a week ago to understand where the growth is coming in this company, as well as looking at historically how well they've performed, top line revenue growth, as well as bottom line net income, which has been very rapid over the more recent years. And also quite an important aspect of looking at the health of the company. What is their total cash versus their total debt looking like? And as always, with the updated numbers that we have, we are going to put them through the valuation model, getting to our intrinsic value, our acceptable buy price given our investor margin of safety, and also see what Wall Street are forecasting for upside over the next 12 months, which in fact is very high for this company. We'll also take a look in detail of the DCF model. We want to run through 3 different scenarios, a low, medium, and high, so you can also understand where our projections and numbers are coming from over the longer term. So let's just have a very quick look at essentially this company. Now we do know year to date they have been hammered. They are down around 29%. As we mentioned, they are trading at their 52-week lows, and we do see a buy rating from Wall Street, although we note a double hold from Seeking Alpha and Quant. Now in terms of their top line revenue growth, with typical companies that are more mature, we do anticipate 3 to 7% as a baseline. What we note for Snowflake, 97 million reported in January 2019, 2.8 billion in their more recent annual report of January 2024, so very recent, and we can see the very strong growth that they have had. Graphically, it is very, very rapid year on year. If this does continue, as we will look through their investor presentation, this could be one of the best growth companies that you do hold in your portfolio. One thing that we will say, however, is that they do need to improve on the bottom line. Whilst their top line is growing very rapidly, what we can see is every year they have made a loss. But one thing that we want to highlight is that the loss has started to get bigger. So this is one area that we would consider as an improvement and something that we will factor into our margin of safety as we run through this company and the valuation shortly. In terms of the health of this company, well, it does look very good. We do a quick cash and short-term investments versus total debt. 609 million on the balance sheet in January 2019. 3.5 billion in that latest quarterly report, so their cash balance has been increasing over the longer term, although we do note over the last 4 years it has remained fairly flat. Now in isolation, that number doesn't really mean anything, so when we compare it to their total debt numerically and directionally, well, 16.7 million in 2019, 278 million from their latest report a few weeks ago, so it is very, very small. Even though it has been increasing over the longer term, it is very tiny in comparison to their total cash, so their balance sheet looks very good. It won't even take them 1 day to pay off all of their debt net of cash on hand. How does their earnings look in terms of historical and forward looking? Well, out of the last 4 quarters, we note they did beat 3 of them, so a 75% track record, but their more recent quarter they did miss, although you could argue it was marginal. In fact, as we see here, by around 3 cents. Forward looking, well, the next 3 quarters they are anticipating double-digit decrease year on year to their earnings per share. You have to go as far forwards as to Q1 of 26 to see strong double-digit growth to the EPS. So something to factor in, but we can also look at what this is looking like over the next 5 years. Just something that we do want to make you aware of with this company over the next few quarters so that we do have those realistic expectations. Now, in terms of the valuation grade, this is the first one that we are looking at. They do get a D+. Now, do remember this does compare it to the sector median, although we do note it is sitting very high, 227 versus the sector median of 23.32. But we'll take a look at why it is so high, as it could be that they have a lot of growth and they have some very high margins. There are also other valuation methods if you want to use, but our overall conclusion for this part is, in comparison to the sector median, it is a lot higher and therefore you are paying a premium, but you could argue the sector median doesn't have a lot of growth that Snowflake has. So let's keep moving on. Growth grade, well, they do get an A-. We can already see here some instances of what I just mentioned. 33% increase year on year on the top line, while others in the sector, a basket of them around 3%, so very low in comparison. They're still anticipating very strong growth moving forwards, 28% with the sector at 6.5%. And when we do take a look at this one that I did say over the longer term, they are anticipating growth over the next 3 to 5 years on the EPS, 25.8%, whilst others just under 14%. So the growth is there for this company. They do get an overall A- grade. You can in fact see the other ones if you do want to include it within your own investment thesis. We then move on to the profitability grade, so they do get an A- here. Few things that I'd like to draw your attention to. The gross profit margin, very high, 68%. As we can see here, the sector median, 49.52%. But when we do look at their bottom line, it is a very high loss, in a net loss margin, in fact, 31%, sector median around 2.72%, something that we would like to see them improve over the next few quarters and the next annual report, as this is a company with rapid growth and a very nice gross profit margin. We also note their cash from operations is also a lot better, significantly better in fact, than the sector, 904 million versus 88 million. Before we move on, just a quick update or conclusion. In fact, a buy rating on Wall Street, a double hold, a D+ on the valuation, an A- on the growth, as well as an A- on the profitability. We then take a very quick look at how they've performed over the last year. We're looking at others in the same sector. We have Cloudflare, MongoDB, Shopify, as well as a few others, and we can in fact see that they have returned negative 11%, pretty much one of the worst performing in the industry. But we can also point to the fact that only one has had a very good performance, as we can see GoDaddy up 91%. Otherwise, all the other ones have been very mediocre and in fact a negative performance. Now, it doesn't mean over the next year or over the next few years they will return negative as well. It is just something we like to look at as one part of our analysis. Past performance, as we always say, is never an indicator of future performance. Now, inside ownership, you could argue fairly high, just under 8%. Although we noticed 2 instances of insider buying, but remember over the last 12 months for an amount of just under 6 million, with 9 instances of insider selling. Quite a significant amount, 265 million, so much higher than the insider buying that we do note today. Quarter 2, more recent figures, 3.51 million of shares sold. Quarter 1, we do see both buys, but again, that is outperformed by the sells, quite a significant amount. And for those that are interested in noting who they are, well, in fact, we do see on the 24th of May, Emily H, so very recently, just last week, did sell around 6,500 shares for around $1 million. Now, you do need to go back as far as the 25th of March to see the CEO buy around 31,000 shares, but since then there has been quite a lot of insider selling. As always though, let me know your thoughts whether or not this is something that does put you off from considering this company, or in fact other companies when we do cover the insider buying and selling. We then move on to essentially the institutional ownership, 65%, 4.8 billion worth of sales by the institutions over the last 12 months. During the same time period, we do see a fair amount more worth of buys. On top of that, we also see more buying in the last 2 quarters as well. Quarter 1 to the more recent quarter, 1.05 billion versus 733 million worth of sales. Now, do remember that this is something that you shouldn't really take into account or copy. Always do your own due diligence. Never follow insiders or institutions. We just like to see whether or not there are any massive red flag indicators. Right now, though, nothing to say on the institutional buying. In terms of insider selling, well, we don't really know why they sell, personal or financial reasons, but again, every investor will come up with their own thesis and where to place this information. Now, before we jump in essentially to their investor presentation, just to let you know, we have released our latest free weekly article. We run through the best recession stocks for the portfolio. If you want to gain access to this or any other articles, all completely free, do click on that pinned comment below to sign up. Instant access as well. We have other articles like 20 undervalued dividend stocks to consider for the portfolio, or how we find undervalued stocks on the channel and all the websites and resources. So we're taking a look at the investor presentation for the first quarter. This was released just a few weeks ago. Now, some of the highlights that we do want to draw to your attention, what we can in fact see here is 34% year-on-year increase to their top line. Always great to see. A very high net revenue retention rate, 128%, and their gross margins, which we will cover in more detail, 77%. So looking very good, but ultimately with this information, we do need to compare it to the same quarter from last year as well as the previous years. Now then we move on to some of the things that we like to see, which is an increase to their top line revenue, but we also have the quarterly breakdown here as well. We can see 33% year-on-year growth over the last 5 quarters. This is what we want to see for a company that does trade at a very high valuation, and we can also see it on a year-on-year basis. Their top line continues to increase. So positive signs, but again, something that we do believe we would expect for a company, as we said, that does trade quite richly. In terms of total customers, well, as always, you do want to see customers increasing, which is a sign of a strong company that does have a strong product as well as services. And when we take a look at their customers, we can see these are specifically customers with over 1 million in terms of product revenue, increasing quarter on quarter. Again, this is a trend that we will keep an eye on as they do release their annual reports and on a quarterly basis. When we take a look at their product margin, well, it has increased 2 percentage points over the last 2 years, but one thing that we do point out, which they haven't really mentioned, is that over the last year it has remained fairly flat. What we ideally like to see in a very ideal world, not always the case, increasing top line as well as increasing margins, something that we have seen when we have reviewed companies like Nvidia. We then take a look at free cash flow, very important. We'll look at this in more detail, but very high level. We do see it drop off over the last few quarters, as we can see here, but since that drop into Q2, it has started to increase. Always very important. Free cash flow is something that we do like to keep our eye on. We do want to see this increase over the longer term. Finally, we take a look at their guidance. A few things just to point out. Well, their revenue is anticipated to continue to increase at a very rapid rate, so that is always a great sign. One thing that we will take a look at and discuss shortly is their revenue growth. What we notice is it has been slowing down, as we can see, and it is expected to continue to slow down 24% into FY25. Margins, well, as I said, increasing revenue, increasing margins. Unfortunately, they do anticipate it to fall from 78% in the full year 24 to 75% in FY25. And we can see here their margins are anticipated to be very mixed, inconsistent. 3% in the full year 25, a drop from the 8% from the last year. And the free cash flow margin, again, another drop. So it looks like their essential top line has been increasing. All the other metrics have been decreasing. So let's consider that when we do now look at essentially their financial metrics. So their free cash flow per share, as always, we do focus on that. Earnings data is susceptible to manipulation by management through accounting. What we do quite like to note is, yes, it has been negative, but since 2021, it has been increasing. 2025 anticipated to continue. Always a great sign. And hopefully this is one that continues to increase their free cash flow over the longer term, especially with their increases to both their top line as well as those customers with the larger contracts. As we said then, sales growth, something just to bear in mind. It has been very strong. In fact, we do see triple digits over a few number of years over the last 5. 36% over the last full year, and as we just said, they are anticipating this to be around 24% over the next full year. Something just to bear in mind. That top line revenue does look to be slowing down. Nonetheless, still very strong, even if they do achieve that 20% or mid 20% target. In terms of total sales, well, we have covered this already. Shares outstanding, yes, we love it when companies do share buybacks. Just want to point out here, they would have diluted your position as a shareholder if you have been someone who did buy in 2019, or in fact every single year they do tend to dilute shares. In terms of ROIC, now we want to see a minimum here of 10% or more. This gives us faith that management can effectively allocate their capital. No surprises that it's negative, given they have been turning a loss over the last few years. And again, the same to be said with the operating margin. The only thing we would say here is it has been moving in the right direction. We would like to see it positive, and when we do take a look at their guidance, they are anticipating around 3%. So not the greatest, but still better than the negative that we do see here in 2024. Free cash flow margin, ideally a minimum of 5% year on year, and it has been increasing from the positive number that we see in 2022. So lots to think about with this company. In terms of the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, remember this correlates to the balance sheet strength. What this says are the number of years it would take the company to pay off all of that debt net of cash on hand. Last 3 years, 0. Next year, 0. A very strong balance sheet. As we mentioned earlier, it won't even take this company 1 day to pay off all of their debt net of cash on hand. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, what we have here are the free cash flows year on year. Average growth rate very high at 80%. Now forward looking, we have gone for 3 rates. The first one we will use is a low rate of 20%. Based on that, with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get here an intrinsic value of 164, showing an undervaluation signal. Now this essentially is a low rate, and this gives implied upside of 17%, but there'll be people who say last year and the year before very large increases, so you should go higher. So 25% at a medium rate, we would essentially be an intrinsic value of $226, giving implied upside here of 62%. Now for those who are a lot more optimistic and want to go for 30%, you would essentially be a 310 intrinsic value, showing upside here of around 122%. Now, if you believe these numbers are correct, or maybe you want to play around, you believe that they should be lower or higher, you can click on the pinned comment below, grab a copy of this model as well as the others, and run your own numbers through to get your own intrinsic value, whether it's for Snowflake or others in your portfolio or watch list. So what we're going to do is take through to the next slide is the lower rate. We are going to be a lot more conservative in today's episode of 20%, and this gives us an intrinsic value purely on the DCF model, as we do believe it is the only one that is relevant for Snowflake, of $164. Now the current price of 139.61, we always start off with a margin of safety of 10%, and remember that is only something we execute on if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So in terms of that, if you believe that for Snowflake, it is a buy up to 147.51. Although if we keep going to see where it's near the current trading price, we can see in today's episode it does have a 15% MOS level. But do remember that this is essentially on the fact that we have gone with a growth rate of 20% forward looking. If we went for higher, then the margin of safety would also be higher. And the opposite is true. If we went for a lower, it would also be lower. Now, in terms of Wall Street and what they anticipate over the next 12 months, well, they see massive upside. They have 48%, their price target $207.14. They do consider this to be a buy, as we discussed at the beginning of the episode. Now, for those who want a larger margin of safety, 20% would be at 131, and those at 25% would be 123. But in today's episode, as we said, a 15% MOS level. Now, as always, let us know your thoughts in the comments below. Maybe you think we're being a bit too conservative here, and in fact, we should be taking the 25%, or maybe in fact, you do believe this to be reasonable, and it is one you are considering with a 15% margin of safety. As always, if you enjoyed the content, values being provided, smash that like button, hit that subscribe and bell button. We'll see you all in the next episode, and let us know your thoughts below. Take care for now.